Flattish open here on the advanced decline line. We're sitting at the lows for the day. Tech is lagging. That's part of the problem. Remember, tech has been a huge leadership group. So just take a look at the sectors here. Down a little bit this morning here. Banks, energy, industrials, all a bit on the flattish side, as you can see here. Banks, the only sector on the upside. We're going into September. There's a famous old trader saw September is the worst month of the year. And technically it is since World War II. It's down. It's August, September are the two worst combination months, as you can see, down fractionally. But I think the traders are very less impressed with these seasonal trading patterns than they used to be. And the problem is they don't work very well in the last decade or so. For example, if you look at the September's the worst month indicator, September's actually been up 3 of the last 4 months, if you put up the next chart. And so a lot of these old trading patterns, sell in May and go away, September's the worst month, the January effect, Santa Claus effect, all these famous saws that the traders use haven't been working as well. And some people believe it's because the Federal Reserve has been flooding the market with so much liquidity, it overwhelms these very delicate seasonal trading patterns. At any point, it's not hard to figure out why the market is at new highs. When you get this combination of, number one, earnings are at records in terms of dollar amounts. Number two, the earnings estimates continue to go up in the third and fourth quarter. And number four, you have a record profit margin north of 13%. Folks, that's what the stock market moves on. Earnings estimates rising or falling, margins rising or falling. So no mystery on what's going on there. And there's also a very clear rotating factor that's been helping the markets as well. So this quarter, we see a pattern here. The S&P 500 tends to be larger cap stocks, outperforming small cap stocks, growth outperforming value. This is the exact opposite of what happened in the second quarter. So we're rotating around here. Cyclicals did better in the second quarter, which tend to be value stocks over growth stocks. So again, it's this rotation that keeps helping the market out. Little over 60% of the S&P is up in the second quarter, believe it or not. That might surprise people, but if you look at the top 5 companies, when you get 5 companies that are essentially 25% of the S&P and they're up this much in a quarter, the S&P is only up 5% this quarter. Those stocks are almost enough to keep overwhelming the market. So this is that problem with the selective rotation with the big caps moving forward. Finally, just on payment for order flow, I know you guys were talking about this. The SEC has just got a proposal for comments out. They've got a long, long way to make anything happen. There's a lot of different types of payment for order flow, not just Robinhood. The NYSE and Nasdaq engage in a form of payment for overflow, for trading, payment for order flow. Options markets also do that. So there's going to be a possible vote by the SEC Commission down the road. But Mike, my sense here is that's not going to happen. My sense is the ultimate goal is just to get more transparency out there, more disclosure, opening that genie in the bottle of payment for order flow and defining what it means. That's probably a pretty tall order.